So with us this morning, we have Jim Patty, who's the partner in Mayor Brown from the States and the sort of the legal side of it, if I can say, and Wan Ning Lee, who's the Director, Capital Market Solutions with Standard Chartered Bank in Singapore, who's really the deal structuring expert. So let me hand it over to both of them and we'll walk our way very trepidatiously. And I'd like Stefan Hruska to please come and join us. And Stefan is, like me, ADB staff. We're going to be perhaps intervening and asking for some clarification as we go through. And Stefan is in our private sector group, so he too is another expert in this deal structuring. Okay, thank you.
Good morning, and welcome everybody to this morning's session on leveraging remittance flows. Thank you very much, Rita, for the welcome. Let us take you through the slides, and in particular, what our goal is for today. To begin with, we will describe techniques for using international remittances to finance a nation's development, people, and companies. We'll describe these remittances from a legal perspective and take you through potential investor interests in remittance-backed financings, and finally describe the important role that governments can play in facilitating these transactions and enabling their populations to benefit from the financing alternatives.
One thing, of course, that's already been touched upon is why is this type of topic of interest to this group, really to all of us? And the element that was discussed yesterday was what do individual recipients of remittances do with their money? We spent some very, very interesting time learning about how the individuals use their monies for personal day-to-day needs, of course, for schooling activities, for healthcare, whatever it is, all very important for them. But that is an individual decision, and they spend their individual sums of money. How can we sort of corral all that money on a national basis and really apply it to something that can help the entire community and not just that individual family? So we're here to talk about that, how we can do that. One way we do that, of course, is that we can use these remittances as a form of financing for local banks to raise long-term money that they might not otherwise be able to raise, which money can then be used and invested in the country. So we'll spend most of our time today, we'll be talking about that structure. That money, of course, then can be used for certain purposes. It can be used, most importantly, for development purposes. It can be used to fund infrastructure. It can be used to help finance a hospital or a school. It can be used to make loans to small and medium enterprises. It can be used for a variety of needs that help, obviously, those individual borrowers or recipients of those funds, but also then help, of course, their own families and the community at large. The other thing that's important, maybe Wan Ning can talk about a little bit, is the relationship that these types of transactions help a country to develop with investors in the international market, which helps more broadly to raise the profile of the country and get investors and rating agencies and other parties in these international capital markets familiar with the country, comfortable with the country, and perhaps that provides an opportunity to do other types of transactions completely different from remittances, but that also help the country to develop and to expand. On a similar fashion, these types of structures can also help the local legal framework, the environment for transactions that have international investors. It could be helping to improve the legal system, helping to improve the court system, the way to adjudicate any disputes that there might be under contracts. It could be the way that regulations are imposed upon issuers or withholding taxes are applied to foreign investors. All of those types of ancillary elements can be helped by starting with these types of transactions, which again will then help to facilitate other similar transactions that a country might choose to do. Remittances specifically, we talked a lot yesterday about how many of the recipients of these funds are essentially unbanked or underbanked and have money under their mattress and the like, which hopefully isn't true in too many cases, but we know that there are far too many people who don't have access to banking or the other kind of services that we would like them to have. And these types of transactions help to encourage the banking system to go out and access those customers. Why? Because those remittances that those customers receive now have a greater value to the bank. The bank can now, through its receipt of those monies, raise its own funding through the capital markets and use that to make loans to its customers for development or other purposes. Obviously, this is only of interest to the banks and other parties if it has good pricing. As it's a structured deal that has a form of security, collateral, it is typically something that has better pricing for the banks than a normal type of, say, a loan or an unsecured bond would have. And lastly, another reason that this is of interest, particularly with respect to pricing, is because it can help the issuers obtain a rating from a rating agency like Moody's or S&P that is higher than the country's rating. And that's very important for many investors. An investor may not be comfortable, or in fact may not even be legally permitted to invest in a transaction that doesn't have an investment grade rating, for example. So if a country or an issuer is rated BB, which is just below investment grade levels, the investor may say, it's a great opportunity, but unfortunately I am not allowed by my law or by internal requirements to invest in this deal. If you had the same deal with a rating that was BBB, then I could invest in it. And this type of structure can help basically convert through some form of alchemy a BB deal into a BBB deal, which makes it much more attractive for everybody involved.
So first of all, these kinds of remittances that we're looking at fall mainly into three categories. The first is probably something that you're all very familiar with, most of us are very familiar with, remittance flows that go through banks, either worker remittances or just remittances that we ourselves will send to people that we know overseas or in return for payments. Other remittances also include Western Union or MoneyGram type payments, as well as transfers that you make for credit cards and mobile phones. The second category are more commerce-related flows. So if in a country you are seeing a lot of export businesses, for example in Indonesia, you might see lots of textiles companies selling garments to importers in the US or in Europe, then they are expecting to get paid back in Indonesia from the exporters in the US and Europe. And such payments will come through in the form of remittances as export collections. Also, in some of the countries that we're in, we will also typically see a lot of foreign direct investments. So funding sent over for infrastructure projects, for investments in particular companies that are of interest to investors offshore, and the like. The third is tourism-related flows, which may include credit card net settlement payments. So if you are overseas and you happen to pay for your hotel bill with a Visa or MasterCard or Amex card, then the payments from the offshore entity to the onshore entity will be settled through credit card net settlement payments. You might also see this take place in the form of checks or traveler check payments. In addition, we also have some interesting tourism-related flows in the form of airline ticket receivables or airport landing rights receivables. And finally, we have the various other kinds of flows that you might come across, including international calling card payments, and also including things like perhaps utilities payments, although those tend generally to be more domestic in nature. So focusing more narrowly then on diversified payment rights, or DPRs in particular, in remittance-backed financings, we normally use the term DPRs to define the combination of some of the flows that we looked at before. And the most commonly seen flows are worker remittances sent through banks, as well as export collections and foreign direct investments. These are the backbone of the collateral that is used to support DPR financings. Other types of flows can, of course, be included in DPR financings, but because the volumes tend to be smaller than what you would see from these three main categories of flows, they aren't included. Also because they may include elements of complexity from a legal perspective or from a rating perspective that make it less worthwhile to include those and instead have most originators and investors focus on these three. So when we talk about remittances, what are we talking about, and how does it work from the banking system perspective? So typically, a remittance is born when a sender wishes to make payment to a beneficiary. At the sender's jurisdiction in his or her home country, the typical practice would be to walk up to a local bank, fill out a form, none of which the entries I ever seem to know, SWIFT and IBAN and things like that. But yes, there will be a form. You detail in there how much it is you wish to send, who it is you wish to send it to, what is the bank that they wish for the account to be received at, and so on. And the sender will pass to the local bank in his or her home country the funds in the form of US dollars or other currencies that are accepted. What does the local bank in the sender's jurisdiction then do with these instructions? Well, it will locate the bank that has been identified by the customer, by its customer who is a sender, and advise them of a payment order, an instruction to receive a certain set of funds. And these funds, the payment order typically goes through a system called SWIFT. So at this point, let us take a pause for a minute to understand a little bit more about SWIFT. What is it? SWIFT is short for Society for Worldwide Interbank Financial Telecommunications. It is an international messaging system that's owned and maintained by its member banks and includes over 9,000 banks in more than 200 countries. It's basically a sophisticated and very secure global email system through which over 15 million interbank communications per day take place. It's highly automated and is a very efficient system for processing remittances, and has largely replaced telex and other cross-border interbank communication systems that might have been in use before. Returning then to our remittance, which has now arrived, thanks to SWIFT, at the local bank of the recipient, that remittance now, yes?
When I put in all those details on that form, there's that BSP, an account number, and a SWIFT number, and whatever. So that's why it's...
Yes, that's exactly why it's hugely important to have that.
You get the numbers right.
Exactly,
And
yes.
so we saw yesterday some of the video where the local person was helping the cycle rider how to fill out the form. So this is a critical part of the literacy aspect on some of these. You get those numbers wrong and the message goes to the wrong place.
Yes, or it might just get bounced back. Yes, hopefully. I think it's robust enough as a system that it shouldn't be going to the wrong place. But thank you, good clarification. So at this point, we're at the local bank. They've received funds and they've received the payment instruction, where to put the funds. And that's the final step of the remittance life. Once the local bank has received both, it will be able to advise the beneficiary, here is the funds that you have received from this sender. It may be in the same currency that was sent, or it may be in the local currency, depending on the country regulations of the beneficiary. But ultimately, equivalent funds are received by the beneficiary as was sent by the sender.
I'm going to stand up a little bit just to mix it up. We're going to be with you for an hour and a half or so, so hopefully we'll not bore you too much, and we'll create a little motion here. That's what the slide is supposed to do. The next thing is something that you're going to find probably that you disagree with, that you don't think what I'm saying is correct. Who owns the funds? That's the question. Obviously, they can only be used by somebody who owns them, or somebody who has a right to use them of one sort or the other. Is it the sender? Does the sender, the one who's, say, in Germany or the United States or Saudi Arabia, working, do they own the funds? Does the bank that they approach in their home, in the country that they're living in, such as Saudi Arabia, are they the ones who own those monies? Is it the bank in the home country, let's say it's in the Philippines, who gets that payment order that Wan Ning was discussing, that owns the monies, or is it the beneficiary, the ultimate, say, family member here in the Philippines that is being sent those monies from their family member in Saudi Arabia? Do they own the money? Do you kind of have a feeling, an instinct for what you think is the right answer? Obviously, there are different views on this. The instinct is that when money is sent to the beneficiary, that beneficiary must be the owner. It's the whole process is to get money to that person. So that person must have a clean right to that money. It belongs to them, it's just being delivered to them. As it turns out, from a legal perspective, and when you think about it from really a logical perspective, that's not true until the money is handed to that person. Just like, as you mentioned, the sender originally owns the money at the very beginning of the transaction and then loses ownership of it. The beneficiary obtains ownership of it only when it's handed to the beneficiary. That means somebody else owns it in between. And who are the people in between? They're the banks. The banks own that money. So that's why this next slide here is, in almost all the jurisdictions, the ownership of the money is by each of those four entities at different times in that chain. In the diagram that Wan Ning walked us through, there was the sender's bank, the beneficiary's bank, and the beneficiary. Four different parties, three different contractual relationships, and each time the money goes from one hand to the other, it changes ownership. So here we're going to do again sort of the diagram, and I thought this would be fun, and I hope I get my money back because I trust these people. But let's see. Who wants to be the worker in Saudi Arabia? You want to be the worker in Saudi Arabia? For some reason, they're paying you in dollars. I'm not sure why, but they are. And I guess this means you're going to get this ultimately, but you're the local bank. Okay, and I want those back, by the way. So the first step, the sender, she's worked hard. She's been working on the oil plant. It's hot in the Saudi Arabian sun. She's really earned her money. She's spent the littlest amount she possibly can because she really wants to send the rest of it to her family here in the Philippines, let's say. So, very important to her. What is she going to do? She's going to go to the bank. That will be me. So I'm going to stand here. I'm the bank in the Saudi Arabia. As you mentioned before, you come to me, you fill out the form, you say, here is the person I would like to send the money to. Here is the bank account or the bank or other information that you need in order to get that money to my family member. Will you accept this contract? So the bank, that'll be me, good, I get my dollar back. The bank will say, yes, this form looks in good order, thank you very much. I'll put it in my computer system. Thank you for your dollar. I'm going to put this in my pocket. This now belongs to me. I own this dollar. You maybe will pay me a small fee, of course, for the process. The banks get paid whatever it is, 1%, 2% fee for the process. But what have I done now? I have entered into a contract with Rita. I have said, yes, I agree that I will help you to transfer funds or to arrange for funds to get paid to the beneficiary that you've identified in this contract that I have accepted from you. This is called a payment order. You have ordered me to make a payment to somebody else. It's a contract. Now, again, she has lost ownership of the dollar. I own the dollar as the bank. She has a right to, because of the contract, to make sure that I continue the transaction to make sure the money goes to the beneficiary. What do I do next? Actually, before we do that, I'm going to take a break and say, does anybody know another type of transaction where ownership changes hand that's very similar? It's kind of easy since the answer's on the screen right now. It's a deposit, right? When you go to your bank and you deposit money with your bank, it's not your money anymore, right? It's the bank's money, and you have made a loan to the bank. The bank may pay you interest on that loan. If it's maybe a checking account, they may not pay you any interest, but the money now belongs to the bank, and you have a claim against the bank. You have a right for the bank to return to you an equivalent amount of money. It may not be the same piece of paper. It may not even be the same currency, but you have the right to request that bank to deliver equal funds to you. Not the same funds, but equal funds to you. So the next step in the transaction will be, how do I then, with this contract that I have accepted, how do I get money to Stefan over here? Well, I can't do it myself. I'm in Saudi Arabia. He's in the Philippines. So unless I happen to have a branch there, I cannot do it. So I need to use this contract and the information that has been provided by Rita to work with a bank in the country, in the Philippines, to make payment to Stefan, to the beneficiary. So what do? As Wan Ning described, I have to reach out to a bank in the local country through SWIFT, which is the email system that banks use to communicate with each other. If you ever hear about banks being correspondent banks, you probably know that term. That means they correspond via SWIFT. They can send messages, email messages essentially, via SWIFT. That's a correspondent bank. That's what it means. So I now have to fill out a form in SWIFT. SWIFT has a nice little form prepared for me. I have to fill out all the blanks and send it through this email system to Wan Ning. So I fill out my form. This is all electronic. It's not paper nowadays, of course. It's just all online. And press a button. It goes to Wan Ning. Wan Ning's computer systems will receive this email. We'll make sure it's coming from somebody that they know, myself, the local bank in Saudi Arabia. They'll make sure that the information that's entered is complete. There aren't any violations. The person whose name is on the form isn't a known terrorist or criminal or other blocked person. Presumably, Stefan, you're not. Okay. And then, okay. So if they are not, then Wan Ning will accept the payment order. And what does that mean? That means we have now created a contract, just like Rita and I created a contract. We are now in agreement to do something. What is it we're in agreement to do? I'm in agreement to pay her an amount that's equal to what she pays to Stefan. Basically, I'm indemnifying her for the payment she makes locally. So I lost my dollar. It's now hers. She owns it. I have nothing to do with it anymore. I've received a fee from Rita, a couple of pennies, but now my part of this transaction is done. The dollar is owned by Wan Ning. So in that regard, it's similar to the first contract we just talked about. I essentially have handed over ownership to somebody else. Now, of course, the last part of this puzzle is getting the money here to the local beneficiary. How does that happen? Well, Wan Ning has received the payment order that I sent her. It has the name, maybe the account number of the beneficiary. It's a customer of her bank, so she knows how to reach this customer and say, I just got $1. Hopefully it's more than $1, actually. If it's only $1, she's not working hard enough for you. But if it's a customer of the bank, they will send a letter or a phone call, however it is, to reach out to the customer and say, you have now received some money, and we want to put it into your account or give it to you in some form. Please come and receive it, or I'm just telling you it's in your account now. So how does that happen? Well, Wan Ning can take the dollar, give it to the customer, or put it in his account. Or, as happens in many cases, it can be converted to local currency, and he gets the money. Now, who owns this money? And this is a trick question in many cases. Who owns this money, do you think? Anybody have an idea? You get both. You don't get both. You only get one. Well, it depends who owns this money. If she gives him a piece of paper, he owns the money. He can put it in his pocket and walk away and go buy something with it, hopefully something for his home or his children or whatever the needs are. If, on the other hand, she puts it in his bank account, then who owns the money? there is no money anymore, right? It's just an electronic entry in a bank account, like a deposit, and that means that he doesn't own money. He has a right to get money from the bank, just like we all do with our deposits. Now, on a related point, of course, because these remittances, as was just mentioned, do increase in value to the banks for the reasons we're going to talk about later. The banks can now use their ownership in these remittances to raise funding for their own business. It gives them an incentive to now go out and try to obtain more remittances, as I mentioned before, to try to work with the unbanked or the underbanked, to try to increase the business with those customers, which of course is beneficial to those customers, we hope. It maybe makes that business more competitive, so banks may then be competing with each other more for that type of business, potentially increasing interest rates they pay on deposit accounts. It depends on the competitive circumstance. I know in Turkey, where this is probably the most active because there are 8 different banks that have these types of programs in place. These flows are very important to them, and they compete now. It's an additional component of their desire to compete for the depositors and the customers for these flows, which means that they can, if they wish, offer higher interest rates or other incentives for those customers to come and use their services. So when Rita's working in Saudi Arabia, she can send her money anywhere she wants, right? Because she owns it. She could send it to her family here in Manila, or she can put it in a bank in Germany, right? Or in Saudi Arabia, right? If she does make that choice, then of course that money would not be part of this type of transaction that we're talking about. The only money that can be part of the transaction that we're talking about would be the money that does go to the country. So that is entirely up to the choice of the sender. The sender is the one who decides where does the money go, not only to what person, but what bank, what country, what amount. It's entirely up to the sender. But as we know, and Wan Ning and others will know these numbers better than I do, there are billions and billions of dollars that come into countries like Bangladesh and India and the Philippines every day, right? Every year at least. Some of the money from those immigrants that are from the Philippines and working in Saudi Arabia may end up in the United States or Germany or other countries, and that's fine. We can only work with the portion that comes back to the home country. Now, one bit of bad news. Philippines, one country that has a different law, the only country I have seen in the entire world that has a different law. In the Philippines, there is a rule, as I understand it, and for any of the local lawyers who know this topic can correct me if I'm wrong, if it's changed recently. But last we looked at it, the Philippines has a rule that more or less states that the bank that receives the payment order, in this case Wan Ning, is receiving the money in trust for the beneficiary. And what that means is that she does not own the money. She's holding it basically as if it were a tangible piece of property that belongs to somebody else, and she's holding it for them, and they own it, not her. That obviously is a problem for these types of transactions because since she does not own the money, she can't use it as collateral for any of these types of financing transactions we've talked about. This was a real problem for the government in the Philippines. About 10 years ago, we looked at this with them and a lot of the banks. The government wanted to use these flows for the entire banking system to raise money, to basically pledge all those remittances to raise money from the international capital markets to use for the government's own development purposes. It realized we can't do that because the banks, unfortunately, don't own these flows because of this law that we passed. Unfortunately, and a large number of people have tried to encourage this law to be changed and to be made like it is in all the rest of the world, every country I've ever looked at before. But for political reasons, changes of government, everything else, it has not happened. So the Philippines is sadly a country that has huge amounts of remittances, but is not able to benefit from this type of financing and development option because of essentially 2 words in a law. Why that law was passed is a matter of mystery to me. I'm told it was for the reason that you mentioned before, which is that there was a problem back when some banks, local banks, went bankrupt and their customers were not able to receive remittances. So the government changed the law to say that the banks don't own the remittances. They only hold them for the customer. And that way, if a bank goes bankrupt, the bank's other creditors cannot have access to those monies because they don't belong to the bank. They belong to the customer. Sounds like a good idea, but unfortunately it doesn't work if you want to raise money for this type of transaction, and in all honesty, it doesn't work to begin with. So that's one country, I think, where we've seen this challenge. Maybe if you're familiar with your circumstances in your own country, be happy to hear about that and to hear if there's any particular law that you're aware of that might be a challenge. Two definitions. I've talked a long time and I want my money back. So before I forget, here we go. Give me my money back. I'll buy you a beer later. Two definitions we use in these deals that if you were to look at another transaction that has been done, say in Kazakhstan or Russia or Turkey, you'll see these terms used very frequently. Payment order, we've already mentioned that term, payment order. The payment order is this instruction that is delivered from one party to the other. So Rita gave me an order to make a payment order. I gave an order through SWIFT to Wan Ning to make a payment. Those are two payment orders. The next definition is diversified payment rights. This term we just made up. Actually, it was made up from somebody who worked at Standard Chartered Bank about 15 years ago by the name of Steve Gandy, so I'll give him credit. Initially, these types of deals had been done in Mexico called remittance transactions. And as you might imagine, in Mexico, there are billions of remittances that flow back from the United States to Mexico every year, huge amounts of money. And those monies were used in these types of transactions we did in the late 80s and the early 90s. I know I don't look that old, but I am. The term didn't seem right to Steve. He said, you know, the transactions we're looking at doing are not just remittances, which has a connotation for worker remittances, individuals sending money is in the example we just described. These transactions actually can include other types of payments, as Wan Ning mentioned, export payments or foreign direct investment. So in this exact same example we had, maybe Rita is not a worker in Saudi Arabia, maybe she is a company in Saudi Arabia that bought a product from a company that is owned in Manila. So she needs to make payment to that company for the export that she purchased, or in her case, the import that she purchased that was exported from the Philippines. So again, she goes to me, asks that payment be made to that Manila company, and so on down the payment system. That is a different type of payment altogether than a worker remittance. Foreign direct investment. She wants to invest from Saudi Arabia in a good investment project, a hospital or some other project she's interested in Manila. Same thing. The money goes through the system. So Steve said, remittances is not a good term. We're going to call them diversified, many different types of payments, and it's a payment right. So what is being used as collateral is the right to receive that payment coming down this chain. One thing I should mention about DPRs. You can use any currency flow that you want. Typically, a bank will use dollars. That tends to be the largest international type of flow. But you can use yen, euro, Swiss francs, pound sterling, Hong Kong dollars, whatever you want. And so in a transaction, you can choose which of the currencies you want to include. You can say, I want to include payments from Japan and include yen, or I don't. That's just up to the parties to that particular transaction. What do they want to use? So I'll turn it over to Wan Ning now. You're tired with me.
Let's take a look at something that all of you are probably quite interested in, the investors. So who is it we can talk to? Who is interested in these kinds of remittance-backed financings or diversified payment rights financings? And who might you expect to see in that space? First, let's consider why are they so interesting to investors? Why is it these things are so fascinating, and why have they succeeded for so long in so many parts of the world? Well, we'll begin with the currencies in which they're based. So as Jim said, you can create a DPR financing structure using any currency you want. But primarily you will see that the flows that go across the world from developed countries to developing countries, developing countries to developed countries, or really to any country, primarily they will be in US dollars, yen, euro, maybe to some degree still pounds and Swiss francs. So these are hard currency assets, and these are assets that investors are very comfortable with investing. They understand it, it's going to be easy for them to tap into the liquidity of it if they need to, and if they need to unwind it, it's also easy. If, let's say, they were to invest in something in Malaysian ringgit or in Indonesian rupiah, that might be a little bit more tricky for them because of the hedging elements involved and because it's a little bit less commonly used as a currency. So first and foremost, the assets are in hard currencies, and therefore you have an asset that is in a currency that can be used to match the debt that they're investing in. Also, as Jim discussed, the way these transactions are structured, and we will go into this a little bit later, especially with regard to rating considerations and so on, is because you're looking at individual banks, entities in a certain country, but you're removing the payment obligations from within that country, and you're looking at remittances and funds that are originating from outside the country. What happens is you develop a greater ability to invest based on the strength of your happiness, of your confidence in that particular originator. And you're stripping away, to some degree, some country risk that is involved. If you invest in a senior unsecured bond that, say, somebody in Thailand originates, then the payment obligation for that bond will come from the entity in Thailand. So if anything happens in Thailand, then you are risking potentially some of the payments that are going from Thailand to you as a beneficiary or as an investor outside. So these kinds of remittance diversified payment rights financings that we're looking at take away a little bit this country risk. And this is especially helpful when you have risks in transferability and convertibility. It also means that you're looking at a lower reliance on local court systems. So for the investor, there's greater protection against the credit risk of the originator, and this is in particular the case when you're looking at true sale structures. Additionally, because these remittance-backed transactions are so diverse and the volumes involved are enormous, you can also really tailor the issuance that an investor buys into according to what that investor is looking for. So it could be fixed rate issuance or a floating rate, or it can be in the currency that they wish. It can match the tenor that they wish as well. So you have a great deal of flexibility. You have the ability to invest confidently in one particular entity and take away some of the elements of country risk involved, and you're looking at asset and liability currency matches. Okay? And in particular for developmental entities, you also have the added benefit that these kinds of financings you can use to support local developmental projects, such as lending to SMEs, for instance, supporting energy efficiency projects, or maybe in some cases also expanding the reach of energy generation projects, lending to women in business, and many more. So at this point, maybe we can also tap into the presence of Stefan from the ADB to see what his views are on the investor side.
Thank you very much. Perhaps from ADB's side, if I can add just a few more thoughts. Every transaction that we do with a local bank in our developing member countries always has an underlying goal where we think what is our partner bank going to do with the funds that they raise. So as Wan Ning pointed out, we're not just making a loan, but we're agreeing with the bank that we're working with to invest that money in SME finance, for example, or in infrastructure projects. One very attractive feature of the future flow of the DPR transactions is that it gives us the ability to help our partner banks raise funds at very competitive rates, and that in turn makes it easier to reach their customers, SME customers, for example, or infrastructure projects at a more competitive rate. So in terms of helping our partner banks do their business efficiently, DPRs are a very useful instrument. But it also goes on the other side. DPR bonds are bought by investors who may, in many cases, not be familiar with the bank that has issued it. Let's take a European-based institutional investor, for example. They may have the ability to invest in US dollar bonds, but they may not have the ability to invest in Indonesian rupiah bonds. They may not be familiar with Indonesian banks, but if a DPR transaction, a DPR bond is issued by an Indonesian bank, and may, I think we'll come to that later, may also have a credit guarantee attached to it, perhaps by ADB, that gives this European investor the ability to actually try out investment in the Indonesian market without having to take all the currency risk and political risk that is usually attached to this. It's not a perfect way to introduce investors to a new market, but it's a first step to open new investor bases. In this case, for Indonesian banks, it helps ADB open the door of international investors to our member countries.
Thank you, Stefan. All right, so we'll continue then with an exploration into what is the structured finance market for the investor side, why did it develop, and why is it of interest? Well, structured finance in general provides greater protection against the credit risk of the originator, because you're looking not only at the originator itself and their ability to generate that business, but also the assets that are used to support the structured finance transaction. So true sale structures in particular are very helpful in this regard. It's also a method to mobilize private funds for longer tenors and lower cost financings, because typically in structured finance you're looking at longer tenor assets, for instance mortgages, auto loans, and so on. And the tenor of those assets can be used to match the tenor of the funds that is used to invest in that transaction. And the lower cost element of it comes from the fact that typically structured finance deals are rated, and they're generally rated better than the originator's risk on their own would be. So the higher the rating, the better the cost from the issuer's perspective. So for your originator, better pricing and the ability to reach out to more investors than you might otherwise be able to, and especially as Stefan said, it might create a bridge. And for investors, as attractive collateral. So focusing more specifically on future flow transactions in the structured finance space, what do these add in addition? As we said, it grants investors who may want to look at a particular country but might not be willing to step in entirely in investing in something unsecured in that country, it may provide that bridge. So as Stefan said, a first step into exploring a country that they would like to understand more, but maybe don't have all the abilities or the risk appetite to do so. In particular, when we focus on future flow transactions, what we've seen is that for banks in Turkey, Peru, and Brazil, this used to be the main access for long-term cross-border funding. They would be able to get maybe one-year loans from the syndicated loan market in foreign currencies, but because of where the country was rated, investors might not be able to, or banks might not be able to lend more than a year. Even 3 years might be a stretch. But when you look at future flow assets and you look at the protection that as an investor you would get from such a transaction, and we can look into how later, that broadens the scope for how long an investor can invest in. Also, for these countries, what they did was, as Stefan alluded to, they found a guarantor to work with, a guarantee who could be the bridge between the investor who wants to invest but is unable to for whatever reason, and the originator who wishes to reach out to that investor. The guarantee can elevate the rating of the transaction to something that more investors can find themselves comfortable with. And doing so, it's a baby step, but it's a great step in the right direction because, as we've seen with these three countries, they have now progressed. They still use DPR financings, but because they've been able to get investors comfortable with the country risk, with the development of the banks, with the protection of the legal frameworks and so on, they are now countries which issue senior unsecured bonds very, very easily. So, as we also discussed before, there is an element of minimizing country risk. And because you're able to remove that country risk, you are also able, in some cases, to exceed the sovereign rating of the country. Because also you're looking at the hard currency flows coming in from outside, therefore you have additional protection from things that might be happening inside countries. One of the better things, one of the most exciting things about future flow transactions is that, unlike other types of structured finance transactions where maybe when the economy starts going downhill, you also see the performance of the assets going in the same direction. For future flow transactions, because what you're looking at is really inflows coming in from outside a country to inside a country. In particular, you will see with worker remittances that if the economy is experiencing a bit of a slump, people at home are finding it a little bit difficult to get by, then relatives from overseas will remit more money. So there's a potential counter-cyclicality with regard to how the cash flows develop. And in addition, of course, as Jim said, these are called DPRs for the exact nature that they are diverse. They're very, very different. The types of remittances, the types of sources from which the remittance come are very different. You have export sales, you have tourism sales, you have worker remittances sales. All of these things help to buffer the assets that are supporting a future flow transaction. Okay, so what are the types of investors who we've seen invest in these kinds of transactions? Maybe we work from the bottom down, from the bottom up, that helps. So usually you will see a lot of developmental organizations wishing to add benefit and add assistance to a country, and they are foremost your pioneering investors in these kinds of transactions. You may also see banks who are already comfortable with lending on a 1-year front, on a 2-year front, to bridge that and to expand it. So banks may already be comfortable with lending a loan on a shorter term. With a future flow type of transactions, these banks may be able to extend the tenors of their investments. And then increasingly, you also see asset managers and pension funds, insurance companies, entities which have funds that they wish to put into assets that will last a longer time. And because you can match the tenors of these DPR financings to what they wish for, these types of investors are very, very interested in DPR financings. And these are, of course, all different, or can be different, to who currently exists in a country, because you have that diversity added into the investor base due to structure and due to the increase in the ratings, and because of the longer tenors that you're able to stretch out to. So rushing quickly through, maybe we'll just touch very quickly on the need for ratings, and we can talk about this later as well. But ratings generally benefit a transaction of this type because if you're putting in all this structure, you're putting in all this protection for investors, what is it for, right? You need to see some kind of benefit. And the most straightforward benefit is an improvement in the rating. So provided you meet certain requirements that the rating agencies impose, then it should be possible for your transaction to be able to be rated higher than the originating entity. So if you're able to, with such an improvement in rating, reach investment grade, that's the optimum scale, right? That's the best thing. If previously the originating entity was non-investment grade, but with a future flow you reach investment grade, that's the holy grail, basically. You really improve the pricing that you can tap. But if you can't, then you might need to consider whether a rating would actually work for you, because investors might find it more difficult to invest in a non-investment grade rated country. All right. At this point, we might need to pause for a minute, and I'll pass over to Rita.
going to pause a bit more than a minute. This has been, as you can see, hard going, and thank you for your attention, because building these basic blocks will help to then when we get to the actual structuring. So we've heard the legal elements that are needed, the contractual arrangements, as I say, the building blocks of these deal structuring. So now we're going into the more complex, so try and stay with what's going on and follow through as we work now, particularly how governments facilitate, so what is the enabling environment that you need, but also from a perspective of an issuer or to issue these products, what do you need to do? So we need to understand again this whole landscape, how it all fits together. So Jim, over to you.
Thank you very much, Rita. Thank you everyone for coming back, hopefully a little refreshed and ready for another fun hour or so. As Rita mentioned, we spent the first hour, talking about some of the foundations of these transactions, and I was reminded I should probably help explain again why what I just went through before with the ownership matters. So let's remember how that structure worked before, that payment chain worked before. Rita came to me to ask that I make payment to, or cause to be made payment to a beneficiary in Manila. I was a bank in Saudi Arabia. I couldn't make that payment myself because I'm not in Manila, so I asked Wan Ning to do so for me. I sent her a payment order. She's a local bank. She has a right to receive that money from me, but she now has an obligation to make payment to Stefan. So why is that important for what we're talking about here today? Well, the important person is Wan Ning. She is the one who is relevant for the transaction that we're going to talk about today, which is how can Wan Ning, who's the bank in the Philippines, use the right to receive the money from me, the bank in Saudi Arabia or Germany or wherever I am, how can she use that right to raise funds which she can then use to lend to her customers, which could be any of her different lending customers. It could be for mortgages, it could be for auto loans, credit card loans, or it could be for particular development projects like we talked about before, for SME lending or whatever it is. In fact, the investors can tell her what they'd like that money to be used for in some cases. So keeping that in mind, let's go through a little bit more of the structures. What can Wan Ning do to offer to investors a transaction that they want to invest in and give her money? So the typical structure is what we'll talk about first. It was mentioned earlier, and you all are probably familiar with the term securitization. If there's anybody who's not familiar with that term, I'd be more than happy to talk about it with you later. But I'm going to sort of assume a general understanding of the concept. To summarize, it is basically the use of an asset, a receivable of some sort, as collateral for a capital markets or a loan type of funding. What is done in a traditional securitization is those assets are sold. So for example, if a bank owns mortgage loans, pool of mortgage loans, it can sell those mortgage loans to somebody else. Those mortgage loans in a securitization are sold to what we call an SPV. You see on the slide there the terms SPV, single purpose vehicle. That is a company that is newly created for that transaction. It has typically nothing else that it does. It is a single purpose company. All it will do is buy that pool of mortgages from a bank like Wan Ning, and then what will it do? It'll raise money. It'll sell a bond, or it will enter into a loan agreement, and it will use those assets that it owns as collateral security for that money that it's raised. This is used for all sorts of assets. Again, mortgages are very common, auto loans, credit cards, basically you name it. If it's a payment right, it can be used in this way, and it has been used. In fact, without this, we wouldn't really have much of the great advantage that we have in the United States or Europe or other countries where securitization has been very active we wouldn't have all the consumer lending. People wouldn't make mortgages if they couldn't use a securitization to sell them again and raise money. People wouldn't make auto loans, very few people, if they couldn't do that. For example, a lot of the auto companies have captive auto leasing subsidiaries, General Motors acceptance credit or Ford acceptance credit. And the whole reason they exist is that they can make loans to their customers so the customers can afford to buy a car, but those companies can only make loans if they raise money from somebody. In order to do that, they have to sell the loans, raise money, make loans to their customers who are buying cars, take those loans, put them in a securitization, raise more money, help their customers buy more cars. Without that, many of us wouldn't have cars. Of course, the structure can be abused, and as we know in the recent crisis, there were some structures that were way more complicated than they probably should have been, and people didn't understand. So like everything, you have to be careful with what you do and make sure you're monitoring and make sure that the parties involved are really understanding what they're doing. So this is the basic diagram of the structure. Again, the term we use is originator. For the company that owns this asset, like Wan Ning, she'd be called an originator. She sells the assets to the SPV. The SPV has now this pool of assets. It then has liabilities. It will raise funds from investors, as it says there in the slide. Those funds could be a loan, it could be a bond, it could be a variety of different things, but in one way or the other, it's raising money and it's pledging the assets to secure that money. In some deals, as we mentioned before, you might also have a guarantor. That guarantor could be a private for-profit company. It could be a developmental organization such as the ADB. That said, what we're talking about is not a securitization, just to be clear. It has very similar elements, but it is not a securitization for reasons that we can go into separately. The most important reason is that in most securitizations, in a traditional securitization, the seller has no responsibility for whether or not the assets that are sold ever get paid out by the obligors. So for example, if I do an auto loan securitization, I sell the auto loans, the investor is taking the risk that the borrowers of those auto loans do or do not pay off those auto loans. They are now taking the risk. The bank who has sold the auto loans does not have that risk on its balance sheet anymore, does not have to take capital against that risk anymore. There are certain nuances there, but it's a very different structure from the future flow deals that we're talking about here. In the future flow deals, the banks, with a few exceptions, have full recourse. So if the DPRs that are used in this transaction as collateral don't generate enough money to pay back the investors, typically the originator, Wan Ning, would still be obligated to pay the investors. So if you're familiar with covered bonds, which are essentially a form of secured loan, it's a very similar structure to that. So that said, what does a typical future flow or DPR type structure look like? Exactly the same as a securitization. The structure is the same. The contracts are a little different, but the structure is the same. You still have an originator. They sell assets to the SPV. The SPV raises money that it then secures with the assets that it owns. So what then is the difference? We talked about already the recourse. Another difference you might have picked up on is that in this type of deal, is there an asset that exists at any point in time? What does the SPV own? Does it own a big pool of receivables that are going to pay off on a certain time frame? It doesn't. What it owns is an expectation that the originator, Wan Ning, is going to continue creating this flow of remittances for the life of the transaction. Let's say the transaction is 5 years. So the investor is taking the risk that the bank, Wan Ning's bank, will continue in business for 5 years, will continue to create these flows for 5 years in a sufficient volume to pay off the investors. In a securitization, the investors are investing in a deal that already has an existing pool of assets, a whole bunch of mortgage loans or a big pile of auto loans. They can easily look at that group of assets and say, this is the money I expect to come from these borrowers at this time. This mortgage matures on this date. This auto loan has a monthly payment of this amount. That can be calculated, analyzed. That's a very different type of structure than what we have here. So what matters in these deals? What matters is, will the bank, will Wan Ning, continue to stay in business? It's what we in the rating agencies call survivability risk. Will they survive the life of the deal? Another difference in many of these deals is that securitizations have a local SPV. So for example, a company in the United States who does a securitization will have an SPV, a trust, something in the United States. The DPR future flow deals, what's important is to minimize the sovereign risk, the risk that the government can do anything that might affect the transaction. In order to do that in a safe way, you put the SPV offshore in a different country. It could be someplace that is a real country, like Hong Kong or some real location, or what we call these offshore jurisdictions like the Cayman Islands or Jersey or Channel Islands. But it's somewhere outside the political reach of the local company. That way you can get a rating that is higher than the rating of the country. And that, of course, is the goal in many of these cases. Wan Ning, I think we'll talk about some of the structuring options.
Now we move on to some considerations with regard to the structure itself. So there are sometimes references to programs, and we have to consider what is a program in this case. And then basically, it's the same kind of program as you would see in an MTN. A program basically says that here are the ground rules for all the issuances that you're going to be doing in the future. These rules will govern all the issuances by that one SPV, but for each particular issuance, you can set slightly different things. So you can set a different interest rate for one series issued this year, a different interest rate for another series issued next year. But the core elements of a program would remain the same. So why would you do a program rather than a single transaction? And there are lots of things to consider here. So first of all, if you establish a program, because you're setting the ground rules from now until the future, in a way it simplifies things, right? But it also means that it adds some level of complexity. When you're selling the receivables to the SPV, you're selling, you can sell it once for forever in the future, or you can sell it once just for that one transaction. A program allows you to use a one-time sale to issue multiple different kinds of issuances off that one-time sale. So it's helpful. And it's really helpful for future flow transactions where you don't have the ability to say, here is one portfolio of assets that you can look at today. Because as Jim said, these are usually not existing asset deals. So you don't have something that you can look to today and say, I predict this is how it will go in the future. You're looking at assets that get generated every day and that keep changing. So at the program level versus a single transaction, you have the ability to leverage receivables because typically you will have a lot more assets than you will issue of. So as we've said, remittances, receivables, diversified payment rights come in the volume of billions. But you don't see transactions coming out in the issuance volumes of billions because there is some level of leverage that you need to look at. You need to be able to say, I think this is how much issuance, this is how much the asset cash flows will generate in the future, and based on that, this is how much debt I can issue. But for different types of payments, you can expect different types of volatility, and therefore you will have to consider how much leverage you would allow the program or the issuance to have. So that's one element. Another thing, of course, as we've discussed, is because you're setting the ground rules for the future in a program, it's much more efficient going forward. But at the beginning, it's much more painful. It's costly, it's time-consuming. You have to consider all the legal issues up front that you might face in the future. And that can cost both time and money. but it is helpful because it will allow you to approach a sale once. Rather than having to consider it at every single issuance that you're doing, it's more efficient in that case. So if we move on then to complexity, in places where there are established issuances, a program is very simple because you've probably seen other banks do this, and so the framework, the basic thought process is established. But in places where future flow transactions are a little bit newer and maybe need a little bit more investment to process, because it's so much more complicated, both for the company involved, for the courts, for the regulators, it may be easier to start with a single issuance to begin with. And then once that single issuance is proven, then you can use the same template for the future. Also, if you have just one issuance, then of course, if you decide that, I'm sorry, I didn't really like the terms of all that was imposed on me on that first issuance, you can try to modify it in your next issuance. Looking also then at amendments and waivers, if you only have one series, then you only, what you change in that series affects only that series. But if you have a program, then you might have to consider what are the competing interests of different investors across different series. And in a program, it may be that one series investors can outvote other series investors, and this may make things a little bit more complicated for everybody involved. So in summary, a program versus a single issuance, it very much depends on the circumstances that you're in. Is this the first time you're doing this? Is this the first time it's being done in the country? How much is the volume that you're looking at? How complicated is it to get this past the local councils, the local regulators, and so on? So if we did then pursue a program type structure, what we would have is a master agreement. A master agreement would work very much in the same way, and you would have the same ground rules for the various issuances of a master structure, but you can have different series with different peculiarities, as we've discussed. So different tenors, different amortization schedules, different investors to tap into who might be interested in you at that time. So you might have, I mean, initially it was all just US dollar investors, but increasingly with more flows, with more liquidity in the Eurozone, we are seeing a lot more of these kinds of future flow deals being done in the Euro currencies. Okay, of particular interest to the ADB, perhaps, you can also have series that are guaranteed. So the guarantee would apply just to that one series and to the performance of that series, and not to the rest. So it's also, it provides flexibility for the investor to say, all right, at the beginning I'll issue off a master structure and I'll issue with the benefit of a series, with the benefit of a guarantor. But in the future, if I expect that the rating of my program improves or my flows improve, I might be able to graduate to something that's without the benefit of a guarantee. It also provides you, a program or a master structure also provides you flexibility with regard to what you issue. It can be in the form of a bond or in the form of a loan. And different investors have different preferences, as well as taking into consideration the home country taxation rules. Sometimes loans are better to borrow for rather than bonds. Okay, so let us walk you through a normal DPR transaction structure. So as Jim said, as with structured finance transactions in general and future flow transactions as well, you begin with a sale. And the sale in this case is of diversified payment rights. The sale is from the bank, the originating bank, in Jim's case, me. And I, having identified a certain pool of diversified payment rights that I'm happy to sell, will sell them to an SPV. So how does this SPV buy what it is I'm selling? And what am I selling exactly? So when we looked at diversified payment rights, we identified a whole bunch of different types of flows. As we've also discussed before, these flows are predominantly certain types of flows like worker remittances, sales from exports, and foreign direct investments. There are also lots of different other kinds of flows, but for instance, export-related flows like cash against documents, letters of credit, and so on, Not all of those are included, but depending on the circumstance of that originator, depending on how much flows they have, you can play around with the composition of what it is you include as a diversified payment right. Okay, so the bank, me, I would sell to the SPV whatever I felt I wanted to or was ready to. And I would also sell to the SPV certain bank accounts that are related to how I was receiving those DPRs. And the SPV, in turn, will buy these and finance the purchase of these things by issuing a bond or borrowing from somebody. Nothing very different to what Jim was describing before. So what is it we're selling? And here it's important to just bring ourselves back to the contracts and the relationship between Rita and Jim and me and Stefan. And if you notice, in all the steps, there were two things that were being transferred from one party to the next. And that was the applicable payments, right? The actual money, the dollars or the pesos, and also the payment orders. And these two things are important because it's also important to consider whether you can separate them. So can Jim separate a payment order from a fund that I receive? And in many cases, the two things don't happen at once. They don't even happen together. In some cases, I as a bank will receive the money before I receive the instruction on what to do with it. If I accept the money, then I have to also accept the obligation on what it is I'm going to do with that money. Okay, so the two things always come together. But once the instruction, the payment order arrives at my end, and once the funds arrive at my end, I have a choice. I can do a few things with them. But what we're doing in a normal DPR transaction is I'm doing just one thing. I take the money that Jim has given me, and I take the payment instruction that Jim has given me, and I separate the two. So the funds, thank you, Jim. The funds that I got from Jim, this is my right to receive it. It's a right for me to say, hey, Jim, you are going to give me a payment order. And along with that payment order, you have to give me the money that I'm supposed to execute according to that payment order. So that's one thing. That's the thing I prefer. Then there's the other thing, which is the payment order itself, the instruction on who I am to pay it to and where. And this is not what we sell to the SPV, because the SPV is not going to know what to do with it. It doesn't have a system. It doesn't have the wherewithal to funnel, to put the money into the account of the beneficiary, of Stefan. However, this I can sell to the SPV. So the payment order, I keep. It's an obligation. It's a job, and I accept that job, and I'll keep that job. The money is a right, and this is something that's positive for me. I receive the right, and I can actually say, okay, well, based on my business as a bank, because this is such a fundamental business for any bank in the world really has to be able to execute this kind of activity in order to be able to be relevant as a bank. What I will do is I'll say, look, I have a historical, I know how much I generate in terms of these kinds of remittances. I don't know exactly how much I'll get every single day, but generally over the course of a year and over the course of each month, I know roughly how much it is I'm going to be able to get in terms of assets, in terms of these kinds of cash flows. So what do? I will keep, in the DPR financing example that we're going through, I will keep the payment order. This I don't sell, but this, the right to receive the money, I can sell. And I sell that to the SPV. So we'll go into that a little bit later, but just at this point, we'll also focus on the sale from me as a bank to maybe Jim, you can be the SPV this time. Okay, so Jim is the SPV. He's in the Cayman Islands. Now, going back to the question of how do we view this interaction from me as a bank in the Philippines to Jim, an SPV in the Cayman Islands, what governs the relationship between the two of us, right? It's clearly a sale. I'm giving him the rights to future cash flows that I will receive. But how do you document that sale, and under what law do you do that? And in all the transactions that we've ever worked on together, it's always governed by the local law of me, of the bank that's doing the selling. And why is that? Because when you consider what happens if anything ever goes wrong, right, then you'll have to consider who who would take a look at that contract and who would say, okay, that contract holds true, I respect it, this is what I'm going to do in accordance with what that contract says. And predominantly because these flows that we're talking about are US dollar denominated DPRs, what we're looking at is if there's ever a sale that's challenged by anybody, if this transaction between the two of us is ever questioned by anybody, and a US court has to come in and say, well, I think this is what happens, that US court will say, all right, well, what law do I think applies in this case? And usually it's either US law or that which is possibly more practical, it's the law of my country. So that's why it's usually governed by local law. And that's why it's very important for local regulators and legal councils to be comfortable with the ability for me to separate my right to receive the cash from the payment obligation that I have to Stefan.
Okay, I told you, didn't I, this was going to get tricky. So, this right to something, usually we all know, you buy, sell a house, you buy, sell a car, it's really easy. You can see it, you can touch it. A right to future remittance flows, like this is getting crazy, yeah? But it's still a thing that at law is recognised. So long as you can recognise it at law as something, you can sell it. This is the joy of the law and how we can structure these things. This special purpose vehicle, you've just heard Jim's in Cayman Island. Now, for example, for civil jurisdictions, trust law is not, it's not part of it. So often you have to set up, Indonesia, for example, we had to set up an SPV in Singapore, which can recognise this third party, this entity, special purpose vehicle. So if it's a common law, it's okay. Under trust law, common law has the concept of an agent that you can sell this thing to. But in civil jurisdictions, unless they have specific legislation, we have to do the SPV offshore. So don't get too worried about onshore, offshore, whatever, because that detail will be determined when the deal is being done in your country. So, but just keep that in your mind. Can we set up an SPV locally, or will it have to be done offshore, is one of the things. And can you recognise this future right? Is that in your law, or will that need to be introduced as well? And these are all legal concepts which are very easy legislated for. Well, they're not easily legislated because you can imagine trying to get these ideas across to the politicians, but they're all well-established sort of legal concepts, and there's plenty of legislation templates to look at and various systems to look at. So don't get too caught up in the sort of particular, this really fine detail, just so long as you're understanding this thing that's being sold are future remittances, money coming through over a period. It's the right over a period that this flows will continue, so get your head around that idea. Nothing tangible, nothing immediate. It's going to happen over a period of time. But the law says I can sell that. That's something. That's something they can put a box around and say, okay, we can identify that, we can recognise that, we can sell it. And again, these parties, okay, into the deals. Just to add that.
Okay. And we move on now to the consideration of what kind of debt is it that you place. And as we said, we have an SPV who will borrow funds. How it borrows funds is entirely up to what is possible. So initially we had, a long time ago, SPVs were only established contemplating the issuance of bonds. But as we've seen more recently, sometimes a bond isn't the most efficient way of doing things. There might be tax impact. You're limiting your investor to those who can buy bonds, and that might not always be the same investors who can only buy loans. So you will create, in your creation of an SPV, you would also want to consider, do I want to have the flexibility to be able to issue both? And Jim here will tell you that it's very easy to do both. If you get it right the first time, it's very easy. But let's say you did issue it in the form of a note. What are the types of issuances that you could look at? And there are lots. You could do a public offering, you could do a private placement, but between the two, there's a gulf of a difference. So if you're doing a public offering, there's a lot more information that you have to disseminate, and also you have to consider where you're doing the public offering. If you're doing a private placement, there are also different rules. So 144A issuances are a lot more expensive in terms of time and cost and brain power. There's a lot of blood and tears going to that as well, I think, right, Jim? But then there are also simpler things like private placements to a conduit, which these days we don't have so many conduits anymore, but it used to be viable. Otherwise, you could do a loan syndicated, so to a massive group of people, or just club basis to a select number of investors that you're happy with, or just in the form of a bilateral.
The name gives you an indication what it is. Public issue, it's going out to the public. The regulators need a lot of transparency. Where you're doing a private placement, usually that's to big investors. They're smart, they know what they're doing. The regulators generally aren't so focused on checking this out so well, because it's generally assumed the private placement, the players are smart, they know what they're doing. So just soft regulation on those sorts of deals. So the name, the club, again, a group of people, syndication, group of people, investors who are pretty savvy. So it's really the public issuance, where it's a public offering, that's the one that, for the regulators, that's the one that they're looking, and they write a lot of rules how that has to be done and what information you have to give. So the regulation will depend on who's playing this game, who's investing, and what level of sophistication they have.
But basically, just to summarize, the bank, in our example, Wan Ning, has an asset, a right, and she has a liability, which is an obligation to pay the beneficiary. Those can be separated. Like any contract, you can separate your rights from your obligations. The rights are sold. The rights are then pledged by the SPV as collateral to raise money. The money is used by Wan Ning's bank to make loans or otherwise, help in their business. Let me talk about some of the typical issues that have to be discussed and looked at when you want to do a deal in a country. Is it a good country to do a deal like this? As Wan Ning mentioned, can you have a true sale? Does the local law permit you to sell in a simple one-page contract this right to receive all these future flows? Very important. If it doesn't, then you're going to have to do something. You're either going to not do the deal or have to find a very different structure. Government approvals. In some countries, a government approval is needed for any international financing. It doesn't matter what type it is. In other countries, government approvals are needed for any financing raised by a bank, even if it's domestic. So do you need that in this particular transaction? Are there other approvals you might need from, for example, other creditors of that bank? Maybe the bank has already a contract that says you can't pledge or sell your assets. Well, then they need to get an approval or a waiver from that creditor. Then, of course, you have to communicate with rating agencies, all of the correspondent banks, the people who send these payment orders, the people that collect the money that is paid for these payment orders. There is a lot of effort that has to go into this process. And as Wan Ning mentioned, that's one of the reasons why setting up a program is beneficial, because all that effort that has to go into it can be used for multiple fundraising efforts instead of just one. You don't have to repeat that process each time. So
in Kazakhstan, I think in 2006, 2007, all the big banks did deals. So we have 3 of them here: KKB, BTA, Alliance, and also Halak Bank. They all were experiencing great strength in their economy. They had oil-related flows. The future flow remittances coming into the country was enormous. It was really big, and everybody was interested in Kazakhstan. And we did a DPR securitization for BTA in particular. So I'll focus on this transaction in particular, but the experience and what happened across all 4 transactions in terms of structure, in terms of structure was very similar. In terms of progression, different banks experienced different things. But basically, what happened was, in an underlying sense, the same. So BTA in 2007, at the end of the year, closed their deal, closed a $750 million deal. A year later, towards the end of 2008, the global financial crisis was hitting. It finally reached Kazakhstan's shores, and that impacted a lot of things. It impacted the financial health of Kazakh banks. And it impacted it to such a degree that the government decided, well, this is a little bit too risky for me, and the government held a meeting with all the big banks, and over the course of a few very hectic weekends, I suppose, they fleshed out what was effectively what we could consider nationalization of the banks. In BTA's case, the government decided that they would buy 78% of the stake in BTA. And what this then triggered off for the BTA bank as an entity and BTA DPR financing company as a securitization vehicle was a number of things. So first off, it was a nationalization. And in these DPR transactions, there are typically clauses that are built in to say, well, what happens if things start going wrong? And what are the things that could start going wrong? And nationalization, or change of control and ownership of the originating bank, is usually a big factor in that consideration. So when the government decided to buy almost 80% of the shares of this bank, that got people a little bit worried. It also got the rating agencies worried, and it resulted in the downgrade of BTA to sub-investment grade. And that downgrade also breached certain other protective triggers that were built into the transaction. So what happened in the transaction? So all the different programs have different triggers and what happens in each case, but in BTA's case, what happened was these things triggered early amortization. So there are 2 steps to early amortization. There's a soft part and there's a hard part. But effectively, in this transaction, what it meant was, because certain triggers had been breached and these triggers were worrying enough to investors, the transaction stopped its normal course of payments, and the trapping mechanism that is built into these programs kicked in. So what happened is the flows that were coming in to BTA, they were now under the control of the trustee, right? So what we missed out a little bit in jumping into the section is that when the sale of the DPRs takes place, me as a bank, I lose the right to control what happens to them, and a trustee for the program takes on that responsibility instead. It takes on the ability to say, okay, these flows, please pay into this account, not into that account. So what happened in BTA was, when these triggers were breached, the trustee, which in this case was Bank of New York, said, all right, according to the transaction documents, BTA now doesn't receive 100% of the flows. Some split of the flows has to happen so that investors start getting access to the assets that have been sold to them. And what happened was that the flows that were coming in the name of BTA and in the name of the DPR financing company was split. So 40% of it went to BTA, 60% of it got trapped at the SPV's account. And what that did was it allowed for the acceleration of the debt payment to the investors. So this obviously leads to some big questions as to whether governments were comfortable with it and so on. And in the case of BTA, there was a true sale opinion. So that true sale opinion was ironclad. And even in the course of the nationalization, in the course of all these government restructuring of debts and so on, this wasn't questioned neither by the government in Kazakhstan nor their financial advisor at the time. And it allowed the trapping of flows that I described to happen, which then allowed the investors to be repaid early. So from an investor perspective, this worked very well, and BTA's debt was paid down fully in 3 months. So again, as Jim says, in a crisis situation, everything went according to plan from the perspective of the structure. For KKB, for Alliance, and for Halleck, eventually that also happened. Everybody had different time frames because that all depends on the flows that come in and the transaction that you structure. But the performance, the record, the historical track record of DPRs as a whole is intact. No one has lost money on these things. For BTA itself, to the question on what is it central banks are worried about, well, yes, they lost some of the flows because they had pledged that, they had sold it as collateral, but they continued to get flows, and they continued to receive some portion of what had been sold to the SPV to keep themselves afloat. Anything to add, Jim?
Well, yeah, I would just add, in fact, when we do a new one of these deals or we talk to a new investor, they say, well, what's the worst case scenario? When has this ever been tested? And the example of the worst case scenario is Kazakhstan, and it worked beautifully for all three of these before banks in the country. And they each had different circumstances. As Wan Ning mentioned, both the contracts were different, but also those banks' particular financial position was very different. And they all worked incredibly well. And that's been a great help for when we do these deals for new companies and new countries, because investors now have confidence, even higher level of confidence than they did before, that the structures work well. By the same token, then you have some people like central banks who say, these do work very well, which limits my ability to try to control these flows, right? Because the flows are now being controlled by investors. So the question is, if you're a government official, do you want your banks to be able to raise money and to lend it to your companies and create a healthy economy? Or do you want to stop them from doing that on the theory that if something happens in the future, you want to maximize your ability to grab those funds? To my mind, that's a very easy answer, but everybody has to make their own decision. Let's see. Maybe Wan Ning, you can talk a bit about the typical structure sort of briefly and how you think it might fit within the Asian context.
Okay, thanks, Jim. So in the Asian context, as Don helpfully asked, who's ready for it, right? And at the moment, as Jim said, we've looked into it. Legally, it's a little bit difficult or a little bit unclear in many places. So what happens and what's possible? So ideally, in a country where the legal framework is clear, where the volumes of the flows are strong, and where you have the ability to reach an investment grade, the normal structure that we've described is great. It's ideal. It's easy. It's tested. You can pretty much just transplant it from Peru, Turkey, Brazil to Asia. But in some cases, in particular, some of the countries I've looked at, you might have some obstacles, and the obstacles might come in the form of insufficient volumes, for instance. So remittance volumes may be a little bit smaller than normally seen in these other countries, or it might be a little bit more volatile. And so to support a straight, true blue, full-blown, all bells and whistles kind of DPR transaction, it might be a little bit difficult. So you may wish to look at something a little bit simpler. As we've touched on also, right, you do have to consider whether the legal framework allows you to do so, and whether in addition to what the legal counsels will say, how will the regulators and how will government officials react? In some places, at every step of a transaction, you need to get government approvals, government consent to say, yes, this is doable, yes, you can sell it to this party. And that can take away from the benefits of doing something that's as complicated as what we would normally see. So we might opt for something slightly more straightforward. So, moving on, alternatives.
Alternatives, we've talked about a typical structure. Ideally, that could be used in Asia or any other jurisdiction. But when you hit a circumstance where the typical structure either isn't an attractive option because maybe it's too complicated for a bank that doesn't have a sufficient volume to support a typical deal, or the legal framework just doesn't work for that, there are certain alternatives that can be used. The most common alternative, and I say most common, it's only been used a few times, but the most common alternative is to have a pledge of these assets instead of a sale, right? So again, if you compare it to a securitization by definition really includes a sale of assets. But you can also pledge them. So Wan Ning is the bank who's raising funds. Instead of selling them to me, the Cayman Island SPV, would keep the ownership of those rights, but give them to me in security. So I would have a preference to use that asset to pay myself back over her other creditors. It is a much simpler structure. You're probably all very familiar with secured loans. When you borrow money to buy a house, it's a secured loan. Your house is the collateral for that asset. It's very simple. From an investor's perspective, it tends to be weaker than a true sale. If you have a pledge, it gets involved in, there's greater risk. The bankruptcy courts for that company can do things that restrict your lien on the assets. You're going to be involved in a bankruptcy process to begin with, which you wouldn't have in a true sale structure. So we always prefer to have a true sale as opposed to a pledge, but it is an option. In fact, it's what we do in Russia because a true sale does not work in that context for tax reasons of anything else. And I will say we can't do anything in Russia right now, just by this is in the past, when we could do something in Russia. Bankruptcy risk is the one I mentioned mostly. When you have a true sale, what a true sale means is that it survives bankruptcy, which means that if the seller, Wan Ning, goes into bankruptcy, that sale will still be held to be valid by the court, by the bankruptcy authority. That means that no matter what happens to the seller, the buyer knows that they will always have ownership of that asset. In a pledge transaction, it doesn't work that way. In a pledge transaction, if she goes into bankruptcy, not you, but the bank, then it's going to be involved, my loan to her will be involved in her bankruptcy process. There could be people who have a priority to me. It could be employee wages or tort claims or tax payments that get paid even before a secured lender. There could be lots of other things that are a problem with the lien. So again, we prefer to have a true sale. Some of the other considerations in structuring these decisions are taxes. Just want to touch upon that briefly. When we get to the section that I think we should probably end with about how the governments can help these deals, taxes is a very important part of that. The legal framework, enforcement considerations, what kind of flexibility and rights do the investors have to know that they can go to a local court and enforce their rights quickly and reliably, not have to spend 4 years, not have problems about uncertainty with what kind of judgments they may have. We have some other concerns about the existing contracts that the originator might have. I mentioned they may have existing prohibitions on their ability to sell or pledge the assets. As I think you mentioned before, their systems may not provide the right data that we need for the transaction. That has to be looked at very closely. All those considerations affect the structure that could be used for any particular bank or any particular country. Yeah. So I'm just being told, let's, because of timing, let's jump to probably in a very important part for the rest of us here. And maybe Wan Ning, you want to start, and then we'll kind of share this one.
Perfect. Okay, so as Jim has said, probably one of the biggest obstacles that we face is the legal uncertainty. We're not really sure in the local frameworks of all these countries whether it's possible to sell assets in the form of securitization or securitization type techniques, and in particular whether you can actually sell future flow assets, things which don't exist today yet and which don't even show up in the balance sheet of the bank. So the government's role here is especially crucial. If governments can get themselves comfortable with the legal framework that Jim has described, that we've seen in other parts of the world, then that's a real big step forward. Because in many cases, when we talk to local legal councils, they will have a view, but their view is that of a local legal council, and they would obviously defer to what the central bank or what the Ministry of Finance would have to say about these types of transactions. So governments can help with appropriate legal frameworks, taxation frameworks, and regulatory frameworks. I mean, taxes in a lot of ASEAN member countries, for securitizations, it's already something that gets some benefit. But usually those securitization type transactions are only for existing assets. So we need to just extend that a little bit more to make it a little bit more tax friendly for future flow type financings. In addition, there's also consideration on accounting treatment. How do you account for the sale of something that doesn't exist yet? How would you, and that leads also to the question, how would you tax it? So I think as government officials, if there's any questions, if you're not certain about anything or unhappy about anything in particular, now is the time to ask questions to Jim from the legal framework, and other things from my side that I can help answer. I'd be very happy to. But it's very important for the government to feel confident in these kinds of transactions, because you're really the gatekeeper. You will be the gatekeeper for any future transactions that take place in the country that you're governing over. If you are confident in them, it will naturally flow through to investors to also have confidence in the reliability, in the ability of the local court systems, of the regulatory bodies to respect a transaction like this. And one of the ways that I can think of for a government to demonstrate confidence in this is maybe future flow transactions. In here, we've been only talking about remittances by banks, but governments themselves also have to some degree, or government bodies have to some degree, some element of future remittances that they can receive. For instance, in some parts of the world, government entities have been able to securitize or create financing structures for utilities or airport receivables type transactions. So it's not just limited to banks, what we're doing here. The technology is applicable across corporates and even across government entities.
I want to give one example of how a government can be very helpful. If you look at many countries, particularly sort of in the Middle East and the old CIS region, they have adopted what we'll call a securitization law. And it's great. It's very helpful if you're doing a local securitization. Unfortunately, the drafters of those laws in most cases are only thinking about purely domestic transactions. So the law that they draft, they're trying to be helpful. They're trying to say, I want you as a company or a bank to do a securitization. It makes a lot of sense. They're really smart. But they draft the law in ways that don't work for international transactions. So they don't work well to raise money from international investors. For example, they often only permit an SPV to be established in the country. Why? They should let the SPV be established wherever. So that is a big hindrance to the types of deals we do, where the goal is to get the assets out of the country and have an offshore SPV. They often in the laws will say, we'll only make references to the sales of existing assets. Well, again, that doesn't work for future flows. It might be fine for mortgages, for auto loans, but it doesn't work for future flows. And that was something that is not intentional by the drafters. That's just what they were familiar with, so it made sense to draft it that way. If they had changed one word, which if you had asked them to do that, they would have said, oh, sure, the SPV doesn't have to be in the country. It can be anywhere. They would have done that. So it's just an education process, hopefully, to get the people who draft those laws aware of the concept before they draft the law, because once it's drafted, it's a lot harder to amend an existing law than it is, I think, to adopt a new law. That's at least been my experience. So part of the goal here, and I think it was very helpful for the ADB to set this up and to invite you all here, was to help spread the education so that if something like this does come up in your country, you might think, oh, I remember this idea I heard. I want to see if we can try to address this before we do something that's going to limit the ability of the country to raise money and promote development.
As you can see, we can talk for days, weeks, months on this topic, and we still will just be skimming the surface. It is complex, no question. But the point is, I think what you've heard is you've now got the language, you've got the concepts. You can now start talking with the central bankers, with your colleagues about the idea of this. And this is what yesterday showed us, how much potential there is. And then today we're looking at, well, how do we then, get in the driver's seat and actually use it? So here are we've had some really great ideas and some learning, some serious learning and awareness raising during this session. So please thank our 3 experts who have kept us awake and bemused for the last couple of hours. It was a great effort. Thanks, everyone.